What's going on, everybody? Small business owners, side hustlers, funding CEOs, and partners everywhere. Welcome to today's episode. Today's episode, boys and girls, ladies and gentlemen, going to be a fun one. We're going to be diving into some of the top financial misconceptions, misunderstandings out there around in our country, and especially for business owners and consumers. And it's going to be according to what our friends at CHAT GPT have to say. And if you haven't set up your account at CHAT GPT, you can now get the CHAT GPT Premium Plus version. I think it's $20 a month. So I signed up for that. And one of the good things about it is you're down a lot less. In fact, I don't think I've ever been down since I got the Plus subscription version. So it's kind of like what Twitter's doing, where they have the little blue check mark thing. In fact, I think I need to go through and jump through some hoops on that to complete my verification process so I can be a blue star Twitter boy. So I better get to work on that. Hope you guys are having an outstanding first quarter in this year of 2023. And using AI, there's a lot of different concerns about AI out and about. And, is ChatGPT, they're going to become a singularity and take over the world and become like Skynet in the Terminator movies? Not yet. It doesn't look like that's on par yet. Some of the guys that I like to follow are Chamath and David Freeberg and David Sachs and I can't remember Jason, whatever his name is. They're in the All In podcast, and they're very dialed into the tech world. Each of them have been part of billion-dollar exits with big tech companies, and they're very plugged into ChatGPT. So I've been researching and doing a lot of reviews, and it doesn't seem like we're at that point yet. So from my vantage point, if you're a business owner and you're trying to make progress, increase your market share, be more successful, grow your business, et cetera, then utilizing some of these AI features can really accelerate the growth of your business. For example, Ty is going to be here in just a minute, but I know we've created emails, we've created text messages, we've had it create different scripts for different videos and training, all sorts of different things that ChatGPT has been able to gather, and it just seems like it's a more effective version sometimes of basic search, where search might give you just a few page links. This gives you the actual needed information. I'd say 90-95% of the time it's very accurate. Now, if you get into really obscure, things where there's not a lot of information and it's not really clear what the truth is regarding a matter, or if you get into political stuff, then ChatGPT probably is not going to be the solution that you're looking for it to be. But if you're a business owner, if you're wanting to be able to create sales scripts and emails and text messages to communicate better and more effectively with your client, even put together trainings for your team, then I find ChatGPT is a very effective thing. And if your kids are in school, it can be very effective at helping to organize ideas. Again, you want to encourage them to do as much on their own as they can and use it more as a tool instead of just a copy and paste feature. So here's the most common 8 financial misconceptions, perceptions, confusions out there for people in the financial space when it comes to money. So number one misconception: you need a lot of money to start investing or to start a business. That's number one misconception. Number 2, renting is throwing away money. This one is very interesting, especially with what's happening in the real estate markets right now across the country. This is going to be one of my favorites. Credit cards are always bad. True or false? Ooh, we're going to have a good discussion about that one. You need to be an expert to manage your finances. You can't do this. You need to have, smart guy Joe who's going to manage your investments for you, even though Joe probably has never actually created a ton of wealth for himself. He's just kind of selling products that make him a commission, right? Investing is too risky, so we shouldn't be doing investing. We should just save for a rainy day. True or false? And then high income equals financial security. Like, that's where you get financial security. That's all you need to worry about is just, that high income. And you need to be debt-free to achieve financial security. A lot of people, believe that to be true. They believe financial independence is having no debt. I'm going to share some stories where when I was, quote-unquote, debt-free, I was very far away from financially independent. So that is not always true. And I think most things that you read online, whether it's on an Inc. or an entrepreneur website or really any news website, they'll have some sort of headline that captures your attention. That's kind of that clickbait that gets you curious enough to check into it. And most of the time, those hooks, there's parts of it that are true and parts of it that are false. But you see a lot of gurus, a lot of experts out there who will go all in and say something and state it like it's 100% fact on everything. And most things that we state are not 100% fact. That's just not how they work. All right, and the last one is you don't need an emergency fund if you have a good job. So good stuff here. Let's go ahead and jump into the first here. You need a lot of money to start investing. According to CHAT GPT, this is a common misconception that keeps many people from investing. In reality, you can start investing with as little as a few $100s or even less, depending on the investment. So let's go ahead and unpack this and break this down. All right, you need a lot of money to start investing. Well, that used to be true. Maybe 20, 30 years ago, if you just had a few $100s or a few $1,000s, you actually couldn't really create an investment account because all these investment accounts had minimums that might be $25,000, they might be $50,000, $100,000, and if you didn't have that lump sum amount to be able to put into an investment account in the stock market, in bonds, in a lot of these different investments, maybe a real estate syndicate, you couldn't actually get involved in investing. And what's happened with technology and the internet is it's become much more doable, right? You've got right now we're in the era of the meme stocks and those guys in the Reddit that were investing in GameStop and some of these other stocks. And they were doing it with small amounts of money, but they really pulled together their resources and they all kind of did the same thing and they put power back in the people. It was very fascinating. And they were able to push up GameStop and some of these other quote unquote meme stocks that seemingly didn't have a lot of value, but they were able to systematically push that value up. And then a lot of these hedge funds that were trying to short them were getting, hammered by it. But it was interesting. They were able to invest in some of these stocks and do it with just a few $100s. There's websites and fintechs out there like SoFi.com, Robinhood. I know Ty's been involved with some of these before, and you can start out with just as little as a few $100s and start making investments and growing. And one of the cool things about really getting your money right and saving isn't just to save, but automatically saving to invest. And so a lot of smart people will, all right, every paycheck I'm going to move $100 over to, a trading account or some sort of investment account. And they're systematically doing it. And it's small amounts, but it's growing over time. And so this is a misconception that you can't start investing unless you have a lot of money. True 20, 30 years ago, not true anymore in 2023. You can get started investing with very small amounts with a lot of different trading accounts. Ty, I know you've dug into this probably more than I have. What's been your experience out there in the marketplace with how little you can get started to get used to investing, understanding it, and how easy is it to get started and set up some of these accounts?
It's very easy, especially nowadays, Leo. And that's something that you kind of need to know and understand yourself when it comes to investing and say, hey, I'm the type of person where if that money's in my bank account, I'm going to spend it. So I need to invest it before it hits my account. And that's something I like to think I'm actually pretty good about my finances. I keep really good track of them. I'm not going to spend. I'm good at saving. And I still do this. I have an account with Betterment. That's who I like to use for my small amounts that I just want them to invest it for me. So I use Betterment, and every single paycheck, 10% of that check goes directly to Betterment before I ever see it. My wife does something very similar with SoFi. SoFi has a great investing platform, and you can set it up so that you can put in a checking and routing so that when you get paid, a portion of the check goes right into SoFi, and now it's invested for you. So it's just a matter of, I think the strategy is invest that money before you spend it, right?
Yeah. All right, so I set up an account at SoFi or at Betterment or at Robinhood or one of these places, E-Trade, and so automatically put money in there. And now how do I actually make a decision about what am I going to invest in? What are the different things that you can invest in?
You can invest in anything, like places like SoFi. I mean, Betterment's a little bit different. They manage the money for you. So you go into Betterment and say, I want, based on projections, if I do $50 a week for the next 30 years, with high risk, this is your risk, this is your reward, this is what you could lose. So it gives you a graph that shows you, if I want 100% aggression, 80% aggression, it kind of changes how much you could have or how much you could lose, but they invest all the money for you. Whereas something like a Robinhood, you can do anything from cryptocurrency, Bitcoin, to buying shares of Tesla, to putting in just with the S&P 500. So there's a wide range there. My advice would be, if you're brand new, you've only got a few bucks to invest, I wouldn't go crazy and go start buying these high risk stocks. I mean, I would probably get into more of a S&P 500, let that money start to slowly build until you have more and you can start to get more aggressive and afford to lose it a little bit.
So, you look back at a movie like The Wolf of Wall Street, right? In The Wolf of Wall Street, it was penny stocks, very high risk. They could go to the moon, or you could literally lose all your money. And so a lot of the times you'll see people who are just getting started with investing, and they're like, they've got, I want to invest to go to the moon and back, and I want to, put $1,000 in and turn it into $100,000. And you see some of those stories out there online where someone legitimately did that. And then a lot of people get this misconception that they can easily go do that. And I think the majority of them end up losing their money. So I think that's a good point you're making. Instead of you trying to just pick the winner in a very high-risk stock that could go to zero, if you are invested in the S&P 500 or one of these plans that a Betterment or someone is using, it's obviously going to be lower risk and you're putting more odds in your favor. You're not going to see 100% returns. What are some of the practical returns that, you can see on average with some of these investments?
Yeah, like for me, Betterment, who I keep it at about a 90% aggression rate. I want them to be pretty aggressive with my money. It's different for everyone, but I've been averaging about 10 to 12% annually with Betterment, which is fantastic. With Robinhood, I try and do it on my own, and other than those years cryptocurrency has done really well, I tend to hover around that 3 to 5%. So it's proven that the computers are smarter than me, Leo. But it always depends. But like you said, I mean, if you've got $100 a week, you probably shouldn't be going out and doing options. You shouldn't be putting puts and calls on different stocks and whatnot. But let that money, if you just stay consistent and committed, and let the computers, let the people who do this all day put that money in the right spot for you, that will grow over time.
Absolutely, guys. Now, one of the things I would say that let's look at investing in real estate versus investing in, stocks and bonds and that type of thing. You probably can't get started maybe with a few $100s in real estate unless you're doing maybe a seller finance deal or an option to lease where you can get a property. So even then, I guess there's opportunities where you could get into that with just a few $1,000s and get started. So what do you think, is real estate different where you actually do need more to invest successfully in real estate?
I mean, it's definitely easier if you do, but like you said, there's things you can do with wholesaling. There's things you can do with seller financing, credit partners. I know that's something where my cousins come to me and said, Ty, I've got enough money to do some rehab work on a home, but I don't have the income to qualify for a mortgage. What do you say you go get the mortgage and I'll fix the house and then we split the margins? I mean, there's ways to get involved in real estate. You just have to get creative.
Let's talk about wholesaling real quick before we go to our next financial misconception. But wholesaling is this idea where you find a property that's worth a lot. Maybe it's a fix and flip and you need $25,000 worth of fix on it. And once it's done, it's going to be worth like $125,000 more. Even in today's market, values are still holding strong in a lot of places like Utah and Florida and some of these, California. I just did a podcast with an investor in San Diego. So a lot of these places are staying strong. They aren't dipping much in the values. So if you find a good deal like that, you just get it under contract for maybe $2,000, $3,000, $5,000. And then if you're dialed into a real estate community, you're like, you go to someone like Ty or myself, like, hey, I've got this property. It's a great deal. I locked it up for $5,000, and I know you have the wherewithal to close on it, and it's a good one. And I've got 3 other investors looking at it. I will sell you this contract for $15,000. And so you got it under contract for $5,000. You just, basically netted $15,000 out of that, or 10, whatever the difference is that you work out with that buyer. So that's pretty cool. Like you can literally do that within one month, and you can stack this up. And in fact, we did a podcast, I think it was like a year and a half ago, and this guy started out doing wholesaling, and he literally made $1 million just wholesaling. And then he, expanded from there, and he started doing Amazon businesses, and he started, doing bigger real estate investments. But he started off with wholesaling. So even real estate, stocks, bonds, all these things, you can get started being more creatively. It's just how hard do you want to work, and what are you willing to commit to learn that game?
Yeah, absolutely. There's so many ways to make money, especially like you said, small little investments. There's a lot of opportunities now too. You don't even have to be an accredited investor. You can put into different funds that their major focus is real estate. And so, yeah, do your homework on that for sure. But you do not have to have hundreds of thousands of dollars to start investing.
There are these unique alternative investments. I was watching a podcast the other day. One of my guys, it was PBD, I think, and he brought on this sponsor where usually to invest in high-end expensive art, which, by the way, ends up appreciating a lot of the time more than real estate, the stock market. Like if you're in the right art, it can do very well, but you generally need hundreds of thousands or millions of dollars. And so this group said, hey, you want to own a Van Gogh painting or one of these paintings that are super valuable, and you can get started with a small amount and own shares in it. And then as it's bought and sold, you literally are earning those returns on that painting. So it's interesting, so many different ways where investments that used to take massive amounts have been democratized, and people can get started for much smaller amounts.
I saw Logan Paul's actually doing that with sports cards. I played around with it a little bit, where you own shares of a Michael Jordan card worth $1 million. You can own a piece of that. So as it sells for more money, you're making that nice little difference. So it's interesting. People are so creative with investing.
And one of the best ways to define if it's a good investment is it difficult to duplicate it, right? So if you have that property that's 10 minutes away from Disney World, or it's on the beach, or it's at Island Park by Jackson Hole, or one of these really heavy recreation tourist type places, well, you can't easily recreate that. And it's especially true with sports cards, right?
Yeah.
You have a valuable Michael Jordan or a Patrick Mahomes or a Tom Brady, a rookie card, or one of those high-graded cards that it's not going to be duplicated. You can't recreate it. Those are going to be extremely valuable over time. The difficulty in duplicating something makes it that much more valuable.
I've got a funny story about that with sports cards, Leo, because my wife is always like, Ty, why do you keep the duplicates? Like some 7th round draft pick that you got his rookie card in every pack because it's not worth anything. You've got a million of this random ass 7th round pick. Why are you keeping the duplicates? Well, guess what? Back in 2001 or 2000, I can't remember exactly which year it was, my dad got a bunch of 7th round draft pick rookie cards of a man named Tom Brady.
Oh.
And he hung on to those duplicates, and he since passed them on to me. And I was telling Marie, I said, that's why you hang on to the duplicates, because you never know when the next, maybe it's Brock Purdy. Guess what? A lot of people might have thrown out Brock Purdy cards because he wasn't ever going to be anything. And then all of a sudden it's the next Tom Brady, and they're worth thousands of dollars per card. So sports cards are funny.
Sports cards. Not easily, you can't duplicate it. You can't go recreate those that were printed 10, 15, 20, 30, 40, 50 years ago. So those are the types of things that you want to look for that are not easily duplicated. They're going to be valuable for years to come. All right, our next financial misconception, according to our friends at CHAT GPT, is renting is always throwing away money. And CHAT GPT says this is a myth perpetuated by some people who believe that owning a home is always a better financial decision than renting. In reality, the decision to rent or buy a home depends on a variety of factors, including your financial situation, lifestyle, and long-term goals. So that's interesting. Whenever you're talking about any type of investments, a lot of times it comes down to the timing. Like, when did you buy it, right? Yeah. So if you bought a property in, one of those markets that was appreciating like crazy, let's say maybe Boise, Idaho, and you bought in March, April of 2022, well, you fast forward a year later, you might be underwater with that. But if you'd bought that same property 2 or 3 years ago, you probably have quite a bit of equity into it. So it always depends when you buy. But over the long run, are you going to lose money, investing in a home versus renting? What do you think, Ty?
No, I think in the long run, buying the home is always going to make more sense. But like you said, timing the market can be a difference of hundreds of thousands of dollars, right? If you're getting a 6% versus a 3% and you projected that and you made the decision to rent for a year because you thought rates were going to drop. Granted, you could always refinance. So it's not, I guess it's not resulting in hundreds of thousands of dollars. Where this made sense to me, Leo, I know this is more talking about homes, but I immediately thought of my car situation, right? And a lot of people say leasing is a terrible idea. Don't ever lease. And in some instances that is true, but for someone that knows they constantly like to get new cars, leasing is a fantastic option. And if cars are semi undervalued right now. So in 2017, I leased my truck, and ultimately with a lease, when the day you lease it, they have to give you a dollar amount saying, hey, 5 years from right now, when that lease expires, it's going to be worth X amount. And that's a contract. They have to sell, they give you the ability to buy the car or the truck at that amount 5 years later. Well, guess what? Between 2017 and 2023, the values of trucks went up astronomically. However, I had that contract. So they had to depreciate my truck, which the first few years of an auto loan, you're pretty much just paying depreciation anyways. So they depreciate my truck. I got to go buy it a few weeks ago for $17,500. It's valued at $35,000, but because of the lease, I essentially was just making these interest-only depreciation type payments, and now I get to buy it at a much lower rate and have equity in it. So I mean, I think renting a home, I have a harder time seeing that one, but I think leasing also as a business owner, there's a lot of tax advantages when you're leasing as opposed to making an auto loan payment. So
like most things, sometimes it does, sometimes it does not. For the most part with real estate, if you're going to buy a home, over the long run, you're going to win, because over the long run, it's going to generally appreciate it at 5-6% per year. It might go up 20% like it did in 2021. It might come down, like it did in 2022 for the most part across the country. But over time, the stats show that you're going to win by staying. And I think that's kind of the biggest takeaway here, whether you're investing in stocks, whether you're investing in real estate. If you're in it for the long haul and you get in the right location with real estate, or you get into an S&P 500 fund, like the S&P 500 goes up statistically 7 to 9% every year, even taking into account the bad years like 2008, 2009, et cetera. It's going to make you money over time. So, but if you have this short-term mindset, then you might be emotional and, it went down, and you take it and you lock in those losses. And so it's the same thing with real estate. If you know you're going to move within the next 1 to 2, 3 years, like that's a real possibility, and you're not comfortable with renting out the home and managing it, or you bought it at such a high payment amount that even renting it out, you're not going to be able to cover the payment on it while you're gone, then that's a problem. That's where you can lose, and that's where maybe it makes sense to rent versus buy. The other factor I think sometimes to take into account, some of these markets are so expensive, right? Like if you buy a property in Los Angeles that's close to downtown, I mean, 1,000 square feet might be well over $1 million. Same thing in New York City, same thing in San Francisco. Like these are very expensive properties. And so if you buy them, you better be in it for the long haul. And oftentimes you can't rent them out enough to actually cover the payment because they're so expensive to buy. So over time you'll win, but if you're trying to move real quick, if something happens, then that's where you're going to be in trouble.
Yeah, that was exactly my main thought on this. I was trying to agree with CHAT GPT and resonate with them, and I just think buying a home is always a great option. But if you're constantly moving, having to pay all of the fees to the loan companies, to the real estate agents, if you're not your own agent, that can get really, really expensive. So that's where I can see renting if you're in a job that means you're constantly moving and you can't afford to hang onto the home and rent it out.
I think we should share a little bit. I don't know if we talked about this much in one of our previous episodes, but we were sitting down with this mortgage guy. We were looking at maybe getting a larger office, and there was this mortgage owner we were meeting with, and really successful guy. I mean, I want to say he had like 2,000 5-star reviews online. I think we're up to 500 on Google and another 600-700 for maybe 1,000 total. But he had 2,000 on Google alone, so he was absolutely killing it back in the day. But things have slowed down significantly, and he's had to pull back 90% of his workforce. So we were looking at that. But he was talking to us about mortgages, and how the 30-year fixed mortgage is the worst investment that you can ever take because the average person, he was saying, stays in their home about 5 years. So if you stay in your home for about 5 years and you know you're going to move, or you're going to refinance, the problem with the 30-year loan is for those first 5 years, the majority of your payments are going to interest.
Yeah.
And so you're not paying the mortgage down hardly at all. And then you're moving every 5 years. And if you had gotten what he called a first lien, like home equity line of credit, where the entire mortgage is a home equity line of credit, you'd actually have paid a lot more towards principal with that same payment amount. And you have access up to 90% of the value in case you ever had a really good investment or business opportunity. So a really unique, mortgage product strategy there. What were your thoughts with that?
Yeah, when I came into the office a little bit later. I was talking to Marie, so I came in a little bit later, and I heard him saying, all you're required to do is interest payments. And I'm like, is he pitching us on an interest-only loan right now, or what's going on? But then I understood the whole concept of your interest is based on your average daily, but it's charged based on your average daily balance. So if you have a lot of savings or you run a business where there's a lot of cash flow coming in and then it goes out, you can put it all in that account. So instead of paying interest on $500,000, say you had $200,000 sitting in there for a few days, on those few days it's basing it off of $300,000. So it made sense. Or with investment properties where there's a lot of cash flow coming in and then you pay property managers, you pay the mortgage, you pay this, you pay that. I finally started to see how you could save a lot of money. You can always access the additional capital too and loan that money out. So for an entrepreneur, I think he was telling me he calls it the all-in-one loan, which I thought was awesome.
Yeah, exactly. If you're a small business owner, if you're an entrepreneur and you understand that you can, be paying 5 or 6% on that mortgage, but I know that I've got this other deal here where I can make 15, 20, 30% over the same period of time. Well, that's simple arbitrage, and arbitrage being I'm taking this money, I'm paying 5% here, but I'm making 20% or 50% over here. Well, that makes sense all day and twice on Sunday. And so if you have those opportunities, that's the type of loan that can work for you. If you don't, then it's probably not a good idea for you. All right, the next financial misconception was credit cards are always bad. Well, it's true that credit card debt can be a major financial burden. Credit cards themselves are not inherently bad. When used responsibly, credit cards can help you build credit and earn rewards. And if you use them for some sort of side hustle or business launch, then it can work out very well. And it seems like every single week I share the same story here about Kevin Plank, $40,000 in credit cards. Under Armour becomes a multi-billion-dollar company. Russell Brunson did that with ClickFunnels. He said he had his Amex and he used that to fuel ClickFunnels. Same thing, multi-billion-dollar company. Now we used it for our company, which is now an 8-figure company, $65,000 in credit cards. And one of our cards, we started out with a $10,000 limit, now has a $102,000 limit. But most importantly, I think a lot of people still don't understand how you should strategically use credit cards as a business owner and as an individual. What are some of those tactics, Ty, that they really should consider utilizing in what we call smart money strategies?
Yeah, I mean, the only way credit cards are bad is if you're undisciplined, right? If you're disciplined and using credit cards correctly, it's one of the only places you're literally getting free money. Almost every credit card out there, major credit card out there, is going to give you anywhere from 1% to 4% cash back on absolutely every purchase you make. However, if you really dive into it and say, okay, well, this quarter I get 4% back on fuel. Next quarter I get 4% back on Amazon. So you really got to be looking at your card specifically. They come with insurance. Some of them will even insure like your phone, right? You don't realize that, but there's so many different things that come with these credit cards. And in all reality, the only way a credit card's bad is if you're carrying high balances and paying high interest and you can't afford to make the payments. But if you're using them appropriately, credit cards are the best financial resource that we have in this generation, in my opinion.
No question, especially for getting your business off the ground. I mean, obviously, we help thousands of business owners. Some of them qualify for loans. A very, very small percentage will qualify for SBA. And less than just maybe 0.1% might actually get venture capital someday. So 95% of businesses, like, you're going to get launched with either some sort of 5-year personal loan where you're using part of it to pay down some credit cards and using the rest to maybe launch a business, or you're utilizing actually business and other credit card strategies, and you stack those up and you can use those to launch your business just like Kevin Plank did, just like we did, just like Russell Brunson did. And so that being the case, it's about the return on investment. And the cards that we get clients will be 0% interest up to 18 to 21 months. So you have time to generate a return on that money. If you take out $50,000 and you don't have to pay any interest for 12 months and you can make 200% on that money, that's a big win. And that's the smart way to use credit. And then after you're building and growing that business, if you have $100,000 in expenses for your business every month and you make 2% cash back on that, that's an extra $2,000, $24,000 in free money that's coming back to you. You can take your family on a vacation. You can invest that in your betterment account. I mean, there's so many different things you can do. You can buy a real estate property with that additional money, and that's just free money for swiping that card to pay with expenses that you would have used the card to pay for anyway. Now, the key is if you get $24,000 in cash back rewards, but you hold a balance and you pay $24,000 in interest, well, that doesn't really, help you that much, right? It's kind of sixes. But if you pay off your balance and really you have about almost 45 to 60 days to pay off the balance before you actually charge the interest, and you'll see that when you log in, it'll show, balance left from the previous billing statement. As long as you pay that off, then you will generally, in most cases, pay no interest. And now you're almost have like a 30 to 45 day window before the payment's due, before you get interest tacked on. So it's almost free money. As long as you pay that balance down to zero, at the end of every month, you're not paying any interest. And now you've generated thousands of dollars in free cashback rewards that you can use however you want. You can do this as a business owner. You can also do it as a family. And so in our family, we literally use like 1 or 2 cards for all of our personal purchases, especially travel, which sometimes is 4 or 5% back. And you generate all this cash back individually as a family. And that's kind of the difference, I think, between the wealthy. The wealthy use debt as a tool, as a strategy, as something that generates income for them. And most consumers do not. And so it's that discipline, but a lot of it's just education too.
Yeah, that, and I love what you say there when you talk about ROI, the return on your investment. Actually, we would call it the ROL, the return on the loan or return on the line of credit, because a perfect example of, say I don't have $10,000 in my bank account, but someone brings me an opportunity, says, Ty, if you give me $10,000 today, I'm going to close on this property and I'll be able to pay you $20,000 in 3 months. And I put that on a credit card. Even if that credit card is at a 25% APR, all I have to do is cover the minimum monthly payment, 2 to 3% of my balance, so 2 to 3% of $10,000 for the next 2 to 3 months, and now that $10,000 pays back as $20,000. That's a phenomenal ROL. Use a credit card for that all day, every day, right? That's what people don't understand, though. As long as you can maintain that minimum monthly payment until you get that return, that is a very, very sound financial and business decision there.
It is. And sometimes we'll find a business owner who has a lower credit score, a 600 FICO, and the very best loan they qualify for might be a $50,000 loan, and they have to pay it back in a year at 30% interest, but they don't care because they know their business. If I put $50,000 into inventory, e-commerce, whatever business it is, and they can bring in, $200,000, well, I don't even care. I'll pay that interest. I'm making 200%. Minus a 25% interest rate, I'm making 175% of money I would not have made without utilizing that debt strategy, that ROL strategy. And so again, it depends on what you're doing, who you are. But if you think as a business owner, if you think as an entrepreneur and you use debt as a tool, that's why the wealthy do have debt, right? They know if I pay cash for that apartment building, my return is much, much smaller versus if I buy 4 apartment buildings with the same amount of cash, putting 25% down, I'm going to probably make 3 or 4 times higher return because I'm using leverage to control those properties and doing it in a smart way. And at the end of the day, learning how to use leverage in your business as an investor, as someone who wants to get their money right, there's no more powerful concept for you to learn. All right, our next topic here, according to the financial misconceptions, according to our friends at CHAT GPT, are you need to be an expert to manage your finances. While it's true that financial management can be complex, you don't need to be an expert to manage your finances effectively. There are many resources available, such as online tools and financial advisors that can help you make informed decisions. One of the curious things about this is if you've ever followed like hedge funds, and there are all these big hedge funds that literally have billions and billions of dollars of people's money that they are managing, and the vast majority of them do not get better results than the S&P 500. So legitimately, you don't have to be a rocket scientist. You don't have to have gone to Wharton Business School or Harvard Business School to learn to become a successful investment banker. You can legitimately just say, hey, I'm just going to open a SoFi account. I want to track the S&P 500 100%, and 90% of the time you're going to outpace 90% of the hedge funds out there and be successful over the long run. So, boy, technology literally has made it so that anybody who can just be smart and disciplined can be successful as an investor.
Yeah, I feel like I'm using this word a lot today, Leo, but again, it just comes down to being disciplined, just like credit cards. Credit cards are only bad if you're not disciplined. Financial management, it's only tricky if you're not disciplined. We live in a time that we have so many resources, right? Go to myfigures.com and create your account, and you can manage your finances right there. There are a lot of different ways that you can manage your finances today. If you feel like you struggle with it, chances are you're probably just lazy. I know I'm going to get some hate in the comments for that, but if you're not managing your finances, it's because you're lazy, because there are so many solutions, and they're not even expensive anymore, right? You can go to MyFigures for $10 a month, and now you're managing your finances, and you have budgets, and you have tools, and you have net worth tracking, right? You can set financial goals. If you're not doing it, it's on you.
Ty, you know what? Sometimes I see people are like, "Hey, I can't afford this this subscription to this money tool. It's like $20, $30 a month at myfigures.com." And that same person on Friday night, they're at the club, they're throwing hundreds of dollars down, spending a fortune on alcohol and other stuff that is not generating any type of return. And so there's this misperception. One of the biggest misconceptions is that of education, that I can go take out, $40,000 is the average student loan debt that someone graduates from college with. So it's okay for me to go take out $40,000 in student loans and get a degree that generally is not going to generate a return. And I could have, if I'd have started a business and invested that same money in educational, self-education products about money, about being disciplined, about budgeting, about creating an income, a business, and understanding all the things that successful entrepreneurs do. If I'd have done that same thing, that would have been a much smarter investment. And it's the same idea with, well, I can't afford this, but on the weekends I can go blow my paycheck on whatever the hell it is, not generate any type of return, but I can't invest in myself because I have to blow my money on other stuff. And that's the mistake that 80% of the population make, and why 80% will never, create the wealth, the life that they want to. But it starts with making a commitment to become disciplined. You have to become educated, and to become educated, you have to spend time at it and learn these skills. And again, we talk about this. These are not taught in school. And so one of the quickest ways to get there is to find a mentor, somebody who understands it. And you don't even have to find a mentor that you speak with in person. You can start going on YouTube and looking these things up. Find someone who's an expert, who's dedicated their life to helping people on a certain topic, and go all in with that person, whether it's their YouTube channel, their podcast, their products. We've had people, in our programs that went all in. I think of guys like Damon and Francois and others that have literally built, massively successful businesses just following stuff that we learned from other people who were more successful than us. And that's the straight line to success, right there. And so the next financial misconception is investing is too risky, or let's turn it to this: starting a business is too risky. And so it says, while all investments carry some degree of risk, so do starting businesses. Investing is not inherently risky. In fact, not investing can be more risky in the long run, as inflation can erode the value of your savings over time. And I would say the same thing about not starting some kind of business in the long run will be more expensive for a lot of different reasons. What do you think about that?
That it's interesting when they put it like that. Not investing can be just as, if not more risky, because when you break it down, that individual that's been hiding cash under the mattress for the last 5 years, what's their 5-year return looking like right now? Right? Maybe negative 6,
because
7%.
Yeah, it was up to 9% last year. It's still 6.5% is where inflation is. So the value of your money has gone down 9% last year and 6% so far this year.
So even if you put that in a very, very, very safe bond, or whatever you wanted to put that in, say it only made you 2%, putting it in that bond as opposed to hiding it in your mattress is actually a net gain of about 9%, right? Because that money literally lost its value just sitting there. So it's, again, an important concept to understand. Yes, saving is good, but if you can put that savings into something that will get you even 2, 3, 4, 5%, even just to offset the inflation, that way your money isn't losing money while it's just sitting there.
It's so true. And so sometimes, you have to jump through some hoops to invest. And well, let's talk about what we were talking before about investing in buying a home and whether it makes sense to rent. And obviously every situation is different, but I mean, I think of the hoops I had to jump through to actually qualify to buy our home that we moved into. Boy, it's been almost 6 years. In 2017, we moved into that property. And I literally, had to get, I got a loan, I paid off my car, and then I had to get a business loan. And then I had to I was literally moving money all these different places, robbing Peter to pay Paul to get my down payment money. I had some of it saved up, but I needed to borrow here, and I needed my debt to income. So I'm doing all this crazy stuff. I'm like, I hope this is worth it. And I came up with the down payment, finally closed on the house just in time. And that same property now has gone from, we bought it for about $615, and it was valued at over $1 million last year. And so you look at how much equity and growth that property's had over the 6-year period. And even though it was a nightmare to buy it, the return has been substantial. And then, you duplicate that, right? What if I could buy another property and rent that out? What if I could buy a B&B short-term rental property? What if I could invest in some apartment buildings? What if, we've got our friend Jake that goes out and finds other deals, and you just put that money in there, and it's a risk. But when you are working with experts and people who have a system, then your odds for success are so much higher. And so that's what we've done with real estate. That's what you can do with business. That's what you can do with all these different investments. But it's really about just getting in the game. And if you don't, one of the saddest things you'll see is somebody who went through a tough time, let's say 08, 09, had to file for bankruptcy, lost their house, and then 10, 12 years later, they're in the same position. And this is going to be super interesting, because one of the other financial misconceptions is you must be debt-free to achieve financial security. Well, I can tell you, Ty, after 08, 09, when I did go through bankruptcy, I did fail after building a business and investing in real estate. The market turned, times were tough, I'd made bad decisions, did go bankrupt. And after bankruptcy, well, guess what? I had no debt. Cool. So debt-free does not mean financial security. In fact, you could even have your house paid off, but if you don't have any income, right? And a lot of people retire, they pay their house off, but then they actually don't have any income. So if you don't have any income and all you're counting on is Social Security or a small 401k, you're probably in trouble. You've got to have income streams coming in. So being debt-free does not necessarily mean you're financially secure. And most billionaires have massive amounts of debt invested in assets. So it's not, I didn't take out debt for a vacation, for clothes. I didn't take out debt to get an expensive car that actually doesn't make me any money, unless I have it on Turo, which that's another factor, right?
Yeah.
But billionaires are invested in real estate. They might have billions of dollars in loans like a Donald Trump does, and they generate a lot of cash, don't pay any taxes on that cash because they get to depreciate all of that real estate that they own. And that's why the rich get richer, because debt, as long as it's paying for itself and growing, is making you money.
Exactly. That one was interesting, the whole debt concept, because like you just said, the wealthiest people in the world still leverage debt nonstop because they understand the tax advantages, they understand the ROL on that debt. So debt is not a bad thing. Debt is a bad thing, and an investment becomes too risky if there's no proof of concept, right? Or if you feel like your investing strategy is you're just throwing mud at the wall to see what sticks, you should probably go to something like a Betterment where they invest that money for you. If your investment strategy is, oh, I love playing the Xbox, so I'm going to invest in Microsoft, yeah, you should probably give your money to Betterment and let them invest that money for you until you learn how to do your own research and make your own decisions and read the news and stay current with or stay up to date with current events. That's what investing takes. To do that confidently, you need to do the homework and do the research, but thankfully, there's a lot of resources out there like Betterment where you don't have to have hundreds of thousands of dollars to go to a fund manager and let them take that for you. You can invest $50 a week, $20 a week, and Betterment will put that in what they feel and what their algorithms and what their computer decides is the best option for you.
Exactly right. So debt-free does not mean financial security, financial independence. Debt-free can be a great thing if you do have businesses and real estate and investments that are growing well beyond, and as a consequence, you're like, well, I might as well pay my house off because I've got all this money growing. But if you just focus on only paying your house off, but you don't actually have cash flow investments in businesses, in real estate, in the stock market that are growing, then it's going to be very difficult to create financial independence. You might feel good about having your house paid off, but you might not be able to travel at all. You might not be able to do a lot of things. Might not be able to invest in experiences for your family because you just don't have income. And that's what most people do, right? Most people go in what's called the slow lane, where, it's go to college, get the student loans, get a safe job that's not safe, and you can still get fired anytime. And then don't start that business, invest in your 401k, don't invest in real estate or other cash flow businesses, and then hope that when you're 65 years old and you're old and on your deathbed, that you have enough money saved up, you just paid your house off, and now you have no additional income, and people are going to live a lot longer now, so you might live to 85, 90 years old, and you will outlive your savings, outlive your small retirement account, and you lived a life that wasn't your dream life. And that's the lie that most of us are taught. Instead, if you start investing and finding mentors and programs, how can I get my money right? How can I save, not to save or put in a 401k, but to invest? And it's fine, have some of that in stocks, but should I look at real estate as a better investment? Should I look at starting a business where there's two tax systems in this country, right? There's one for business owners and there's one for employees. And so the minute you join the business owner tax system, but by the way, you can still be an employee over here for your company and have another business, another side hustle, and you're going to be in that business owner camp and pay a lot less in taxes, and especially if you can invest in real estate. One of the things about stocks is it doesn't have depreciation. There's no tax benefits investing in stocks, but if you invest in real estate, there's depreciation. There are all these benefits that you get from a tax point of view, but when you join that business owner segment of the tax system, you are able to have a lot more success, pay a lot less in taxes because the government knows you're creating jobs, you're making investments, and that's the power of becoming a business owner and understanding that, guys. So that's the debt-free idea. We've got two left here from our friends at CHAT GPT. The next financial misconception is high income equals financial security. While a high income can certainly make it easier to achieve financial security, it's not a guarantee. It was a while ago, Ty. I met with this couple, and I think I was doing like a home loan refinance for them. This is back in 2005. The guy was making $150,000 a year. His wife was making $50,000. So together they were making $200,000 a year. They should be doing fine, right?
Yeah.
They're in Utah. The cost of
05?
living, that was 05. So that was even less, right? Inflation hadn't reduced the value so much. So they're making $200,000 a year. And I looked at their credit report, and they had $50,000 in credit card debt. And it wasn't used for a business. It was used, I don't know what it was. Maybe there was a few trips to the mall, too many there. There was a lot of furnishings, and they were always just buying, things that weren't actually assets that made them money, right? They weren't taking out debt at 5% or 10% and making 50% on it. That wasn't what they were doing. And so they literally were living paycheck to paycheck. They had only $5,000 saved up in their savings account, and they're making $200,000 a year living paycheck to paycheck. And that's when I realized this is true. There can be people who make $1 million a year, and they spend it all. I think, do you ever watch Sex and the City? Probably not, right?
No.
Yeah, my wife used to watch it, so sometimes I would watch an episode here and there. And Sarah Jessica Parker, the main character, made a lot of money in her different businesses. And it fast forward to like 10 years later, and she had no assets. She didn't own any real estate. She didn't invest anything. She had spent literally millions of dollars on clothes and parties and travel, and she had nothing with all that money, all that income, because she was always trying to keep up with whoever the Joneses were in her area of New York City. And that happens to a lot of people as they make more, they spend more, but they don't invest more.
Exactly. And a lot of the problems with this too is they get locked into some of these expenses, right? I agree with you, Leo. Some of the highest earners that I know, the highest earning individuals I know, are also the brokest people that I know, because they're spending every single dollar that they make. And not only that, but they're locking themselves into long-term leases, long-term auto loans, long-term mortgages, and they're professional athletes. So guess what? Yeah. You get hurt, you lose the contract, you don't, or they're summer sales reps where they're making great money 6 months out of the year, and then they come home and realize, oh my gosh, that income goes away, but that rental contract doesn't, and I still have to keep paying that. And so again, it comes back to the word. And I dare say that all of these, financial health in general, comes down to discipline, right? Same exact thing here. High income equals financial security. That's not true. High income with good financial discipline would equal financial security.
So Ty, I think that brings up the question, how do you build up more discipline in your life? Because there's discipline in a lot of different areas of your life, but how do you actually, and I've got some ideas about this, but what do you think are some of the best ways to increase your financial discipline, your discipline in general? Because to succeed in almost every area of life, it takes some form of discipline.
Yeah, I mean, it comes down to accountability, right? If you want to be better at being disciplined, then you need to start holding yourself accountable. And the way you hold yourself accountable is you push yourself, you set goals. You break those goals down into micro goals, and then you hold yourself accountable to achieving those goals. And before you know it, you're going to be a disciplined individual. That's what it comes down to.
And you track it, right? If you're not having a money date every single week with you, with your spouse, with your money, if you're not going through your money and you don't know where you stand, you don't know where your credit's at, you don't know where your debt's at, you don't know where your investments are at, you don't know where your business is at. And unfortunately, I think 70, 80% of business owners don't actually know if they're profitable, where their profitability is at. And so that's why we're building this My Figures app, and we're documenting this process, and we're building out this clever cash flow tool, which was, what a great name you came up with, Clever Cash Flow, that's going to help business owners manage their cash flow and know that they're actually making money. And we're going to use the Clever Cash Flow tool for business owners' personal finances. Are you making more than you're spending? If not, that's a problem. Now, in this country, we have a problem with our government, right? Our government spends a hell of a lot more than it brings in, and yet it keeps on increasing, tax revenue and tax interest, et cetera. But we spend more than we bring in, and we cannot do that as entrepreneurs. We cannot do that as parents, as people who are responsible for others. We've got to spend less than we make. We've got to be, profitable and grow that net worth, and it takes discipline. One of the ways that you can build discipline, I think, is by creating a schedule and sticking to it. A lot of the times I look at my kids and they struggle with schedules. They struggle at getting up when they have to. They struggle at getting their homework done when they need to get it done. And so building out a schedule and sticking to it, that will build discipline. Tracking things will build discipline. If you're not tracking your net worth in the My Figures app, then your odds of success go down. If you're not tracking your business profitability, you're going down. If you're not tracking your health, if you're not tracking, well, I wanted to, get in better shape this year. Well, have you been doing your workouts every week? Have you been eating better? Have you been documenting it and writing it down? If you don't track those things, you're never going to improve in it. So it begins by deliberately taking action in your calendar, building out a system that you're going to follow through and a schedule. If you do that, now you're becoming more disciplined, and now you start to feel stronger. And that's one of the reasons why I did the 75 Hard Challenge 2 years ago, and I've done some of the additional phases of that, but it makes you be disciplined, and you have to do 2 workouts a day, and you have to eat right for a day, and you don't have to go to that extreme, but you have to be able to set goals, work towards them, and be disciplined and track them. And then probably the biggest thing, you have to not lie to yourself, Ty. That's hard for a lot of us. We've all taken turns lying to ourselves. What have you been able to do to succeed in so many areas of your life to where you can be accountable? Because you can be disciplined, but if you're lying to yourself about your discipline, then you also have to be accountable.
Yeah, when you really break it down, it seems like if you're someone that lacks discipline, I think a really good place to start is you've got to give yourself some wins, right? There's got to be some of that initial self-belief. And so if it's someone that it's like, hey, I've been lying to myself, I have good genetics, so my body looks okay, but realistically, I haven't worked out in 2 years, you probably shouldn't start the 75 hard day one, right? That may not be the best commitment to make because you're likely setting yourself up for failure, but commit to, I'm going to go to the gym and I'm just going to walk for the first week for 30 minutes, 2 or 3 times a week. Give yourself some of those wins so that you can generate that self-belief. And as you generate that self-belief, you can continue to push yourself harder and harder to where, guess what? You do gain some discipline. You do gain some accountability. You do believe that when you put something on your calendar, you're going to do it. That's mine right there. Like you said, put it in a calendar. I have to take an antibiotic 4 times a day right now, and I know that if it's not on an alarm, I won't take it. So I set an alarm 4 times a day that tells me I'm going to take it because that's how I know myself and how I'll be accountable. That was good timing.
Good timing. Yeah. Set those alarms, put it
You're
in your
good,
calendar.
Jillian. It wasn't you.
If it's not in your calendar, it's not going to happen. And it doesn't matter. You just have to start, right? If you start where you have no net worth or you do have these debts, okay, great. My goal is I want to pay off this credit card in the next 2 to 3 months. I'm going to start this side hustle so I can make extra money to do it, and you work towards it. I want to get in better health. So for the next week, I'm going to try and avoid eating white breads, and I'm going to try and avoid eating desserts and sugars. I'm going to focus on that 1 week, and then you go 2 weeks, and you start to build strength. And what happens is when we create evidence that we can succeed, then that enforces that we can make progress. And so you start with these little wins. Whatever the little wins are, you document them. Oh, cool. I saved $100 on this paycheck. I haven't done that in a while. I've been actually spending more. And my next goal is to save $125 on the next because I'm going to do this extra thing. Talk to if you don't work somewhere where you can actually be an entrepreneur and come up with ideas, then you need to look for those opportunities. Obviously, a lot of you are, in this audience are business owners. And so how can you increase your income as a business owner? How can you be more productive, more profitable? And at the end of the day, it's not always working the 80-hour weeks, but it's getting more out of leverage. And so as a business owner, you have to be able to leverage your time with systems, with processes, with a team, and with activities that can be leveraged. Media is one way to do that. With social media, you can also leverage software, right? If you're in any type of software business or you utilize software to become more effective in your business, and you have automated texts and emails and things that go out, like these are all tactics that are going to make you more successful as a business owner. The last financial misconception is you don't need an emergency fund if you have a successful business or a good job. And while having a steady income can certainly make it easier to weather financial emergencies, it's still important to have an emergency fund. Unexpected expenses can arise at any time, and having an emergency fund can help you avoid going into debt to cover them. So you don't need an emergency if you're making a lot of money. Kind of an obvious misconception there, but what's your reaction to that?
My reaction to that is, yes, I agree. I think everybody should have an emergency fund because things happen that are out of our control. You never know when someone's going to get hurt. You never know if you're going to get sued because someone slipped on ice in your driveway, right? There's a lot of things that you may need some cash while you're waiting on insurance money, right? There's a lot of things that could happen. My only advice on that, Leo, was your emergency fund doesn't need to be cash in a shoebox that's sitting under your bed. A lot of people think that's the emergency fund. Your emergency fund can be money sitting in the S&P 500. Your emergency fund can be money that's sitting there with Betterment. Maybe don't have it in an IRA or a 401k where it's going to take a little while to get it out.
Yes.
But nowadays, I mean, if I've got money with Betterment and I need to access it, I can get it in a day or two.
Cash accessibility is super important. But yeah, it shouldn't just be sitting there making nothing. It should be working for you. If you work for your money forever, then you'll never create financial independence, says Uncle Warren Buffett. If you learn to make money while you sleep and make your money work for you, then the sky is the limit. And so super important to understand that. The other thing I would add to that is Don't just save to have that emergency fund. Make sure you're saving to invest. The name of the game is to increase your net worth, and you do that by buying assets. One of the coolest things that one of my kids did is Marcus just recently finished reading Rich Dad, Poor Dad. And he doesn't love like reading the actual book. He likes to listen to it on Audible, and then I'll have him give me a book report. And if he does a good job and he learns a lot and he presents it well, then I will pay him money because now I know he's investing in himself. So it motivates him. It's a win-win. And as he was giving the lessons he learned from this book, he just learned so much about investing to learn and then taking action. So in this example was a story where basically these two kids came to work for Rich Dad, Robert Kiyosaki, who's the author, and his friend went and worked for his friend's dad, and his dad didn't pay them any money. This is Robert Kiyosaki's Rich Dad. Didn't pay him any money, but he taught him different business principles while they were working. And then they created this cute little business where they're like, hey, kids want to be able to read all these comic books. This is back, I think, in the 80s or 70s or something. And so we're going to bring all these comic books together, and you pay a fee to be part of our club, and now you can access all of these comic books in one place. And so they would do this after school, and they were making all sorts of profits and money because they learned business concepts and investing, even though they weren't getting paid. So most people will, I'm not going to go do this unless you pay me. And that guy who one day wants to own his McDonald's and is like, I'll get paid minimum wage so I can learn how this system works, and eventually I'll own my own McDonald's or whatever the franchise or business is. Like, having that mindset is one of the biggest things you can do to succeed. So wherever you're at, go into it I'm investing to learn, and then I'm going to grow and implement what I learn, even though I might not make a lot of money at the beginning. And most of us have this, we don't have delayed gratification. We just want immediate, I want to be able to order my food and have DoorDash bring it immediately. And we don't understand that these things take time, and investing takes time. And so ultimately, it's be disciplined, understand it's an event, not a process. It will take time. And if you do that, success can be yours. And the biggest regrets you'll have at the end of the day is that you didn't take those actions. It's not always the things we did, it's the things we didn't do that people regret on their deathbed.
Amen. Leo, life's too short to sit and feel sorry for ourselves. It's time to take action.
All right, guys, get your money right, and we will see you Thursday for our next episode.